morning, everybody. It's Friday, November 17th, and this is the Ag Yield War Room. My name is Dan Dempsey, and I'll be moderating today's session. As always, if you have any questions or comments, please feel free to enter those into the chat function, and we'll be sure to get to those here during the session. Real quickly, overnight markets, December corn was down 3 at 471 3/4. January soybeans were down 7 3/4, 1352 1/2. And December Chicago wheat was down 3 1/4 at 550 1/4. As we kick it off here this morning, wanted to touch on a couple of points that Ben was making. We've got some commercial decisions that'll be made here in the Wednesday to Friday timeframe of next week with regard to basis contracts. And Ben had a couple of good points he wanted to address. So we'll start it this morning with Ben.
Good morning, everyone. I think it's really pertinent to look at the mechanics of the market. We get to first notice day on November 30th, and that's when people take or start to make delivery on grain. The actual futures market becomes a real possibility of being in there for physical delivery. And basis contracts will have to be rolled. It'll vary by commercial, but with a holiday week, options expiration coming up, there's a really wide spreads from the D's to the March. And if you roll that, you're going to take that hit, that 19 cents, 18 cents. It may be 20 by then, 21, who knows? But there are option strategies that will work to help you price your grain and stay in the market over the calendar that you want to choose. With option prices being very cheap, it's a good risk trade-off because you're getting a true floor. Either way, you're going to spend the 18, 19, 20 cents, but you are setting your floor on your grain. So looking at really wide spreads and really cheap options for anyone who has basis contracts, it's worth consideration to look at. So I think that the variance amongst commercials is out there, but most of them, with Wednesday being first notice day, they will want their customers rolled no later than Monday. And I would not be surprised if some of them start as early as Wednesday and Friday because it's a holiday week. So it's worth a conversation with who you're dealing with. I think it's a very reasonable risk trade-off because that 19 to 21 cents is going to be a sunk cost, especially if we continue to break and you roll. So just something to be aware of and know where your bushel obligations are at and what they're expecting of you for a roll. We do believe that there are a lot of bushels out there on basis contracts and on DP as well. So I think it's something to consider.
That's really good, Ben, and bring up a lot of good points. And I think that kind of segues into, these spreads have been pushing to new lows. We've got, the European models got a little wetter for early next week for Brazil. Certainly going to have to come through in terms of them getting that rain. But I know Dustin had a few thoughts here this morning as we've seen with these spreads that kind of coincided with what Ben was talking about.
Yeah. So we've got looking at the spreads for corn in particular. I mean, bean spreads had already broken, and I think a lot of that had to do with growers were selling beans off the combine at a faster rate than they were selling corn. So raising cash cost of carry at a 8.5%, 9% operating notes. Beans were an easy choice for a lot of growers to sell off the combine and store the corn at a much lower interest rate expense per bushel, that is. So what we're looking at on the screen right now is just the history of the spread from D's corn up to July 24 corn. And so as we're falling, that's showing a wider carry being built into the market. We're down to a new contract low as of this morning, 37.25 cent carry. 37.5 is the new low as of last night, and that's well beyond the cost of interest alone. And we have to remember that this is a function of D's all the way out to July. So there's a couple of spreads that make that up in between there. So another way to look at it is split those two up into D's to March here in black and March to July here in blue. And it kind of tells you a lot about what we think the market's going through right now, is that you're getting to this day that Ben's talking about, these days where commercials are requiring growers that might have delivered corn under a basis contract and weren't really happy with the futures price yet they've got to make a decision if they want to continue to carry that position. They're going to go have to take that hit to their basis contract, not necessarily in fees is the big part, but it's actually the cost of the carry that they've got to add on to that basis contract. So that minus 18.5 we see there on the right hand side of the screen, that's the roll from Dec to March. So that's the 18.5 cents that would come off of a basis contract. So if you were 10 under on a basis delivery, you're going to be 28.5 under off the March contract. So that changes things quite fast for if we continue to see that carry erode into the new year, how the cost of that is going to mark down that cash sale in the end. We did see, very high prices early in the year. So, we get to the end of the year and we're within 10 cents of contract lows. There's obviously been a very large desire by growers to try to delay that pricing, waiting for a better price. And when you force all of these decisions, and I know we've been hyper focused about this in our letters and even in the commentary here, when they force this decision to all go into a 1 week time frame, going into option expiration day, going into first notice day the following week, we're starting to see these moves happen faster and faster. So this March contract in black, we've seen a kind of a complete collapse here to catch up to March, July, in the last couple of days. And wouldn't be surprised to see it maybe test even a little bit wider than what anyone really expected, 20 under. So again, a lot of things that you kind of take away from this, but if you do have HTAs that you have off the December and you want to get them out to a JFM timeframe, now is a really, really good time to do that. 18.5 cents carry if you haven't done that so far.
Very good, Dust. One thing noticed coming in this morning and obviously through yesterday's trade, but crude oil down nearly 5% yesterday. The chatter was, talk of global economic slowdown and just, obviously reduced travel and things of that nature. But I know you had a couple of points to make on that also this morning, Dustin.
Yeah, I've also got a chart on that as well, just to kind of put it into context of what's up here. How big of a drop we've had from expectations. So this is just the December 23 crude oil contract. We were late September there, pushing up into the mid 90s at one point. Now we're back to the lowest levels we've seen since the summer timeframe. We're back into the mid 70s. So that is something that may not be the crutch that all commodities are leaning on, right? If we're kind of rising tide raises all ships, we start to see crude oil fall down into the 60s all of a sudden. I think there's going to be a bit of a question of just that underlying bullish commodity stance. We've had CPI coming in below expectations, PPI coming in way below expectations. Perhaps there's not the story that a lot of speculators had for commodities. So I would say that that's the one thing just to kind of keep an eye on. If energy prices start to falter here, that we might want to get a little bit more aggressive on protecting next year's risk, as we're seeing a lot of growers start to lock up the cost of production for next year. We want to probably lock up the outputs to a similar degree at least.
That's very good. Anything anybody else wants to add on the grain side here before we kick it over to Ryland for our weekly meat update? I know there's quite a bit going on in the meat markets today with cattle on feed set to be released later this afternoon. So anybody else on the grain side or?
Yeah, Dan, I was just going to add a couple comments here, just like how you were talking about South America. It looks like the market's really kind of eyeing that. Obviously, the forecast, everyone will be kind of watching, conflicting from the European and other forecasts here. So, next week's going to get a little bit squirrely just with the lighter volume with the holiday. And if you're looking for targets, I was just looking at some moving averages off the March corn, 50 days at like 496.5, which we're, close to backing up to that, what we saw earlier this week. The 100 days at 506, and then the 200 days 535. So not a bad idea if you want to just put some targets in there. The market could get really thin next week, and it wouldn't be bad if you're looking to get something priced.
Yeah, that's a good point, Brian. Justin brought that up actually. I'd say early last week, and he said that these thinner holiday markets do present opportunities in a lot of instances. We've seen that through the years. It's pretty crazy on our end because things get going haywire, but for the grower, you never know. Maybe that was an unbelievable opportunity. Looking at a question that just came through, and we'll shoot this back over to Dustin, who's been addressing this. But how wide do you think spreads can get? You're not talking
really
about it.
Yeah, I mean it's it's always hard to predict markets, and we're our job is really to try to reduce risk and not speculate too much on where things can go. But historically, we have seen spreads widen to about 60% of full carry when there's ample supply. So that would be like a Dece March, I would say 20 cents would not surprise us. Dece July, 60% of full carry is 48 under. I think a lot of people would be surprised by that number because we really haven't had a year yet to test the new carry rates, right? The new approximate 8 cents a month receipt costs that changed December 2019. Prior to that, it's always been 5 cents a month. So what's happened since December 19? We've had really, really good export programs to China. We've had a series of couple bad growing seasons. We've had war in Ukraine. So we really haven't had a year where, we're looking at large piles or we're looking at an excess corn acreage number like we are this year, or surprisingly large yields and not enough grower sales out forward from the average grower, that is. So I think that 48 under is a long way away still from here. It's another 10, 11 cents in that Dece July contract, but just wouldn't be surprised to see that happen. I wouldn't count on it. Just wouldn't be surprised to see it happen.
Well, and I would add in too that a lot of times these spread moves start to really kind of accelerate when we get into the delivery period if all of these things come together. So as a producer, you have time and price on your mind right now as far as the roll goes.
That's all good points, real good points. A couple of minutes to go here before we open, and I want to kick it over to Ryland. Like I said, we've got cattle on feed here later today, Ryland, and just wanted a quick breakdown of what's been going on in meats this week.
Yeah, no problem, Dan. We're staring down the barrel at another cattle on feed report. This is definitely a little bit of a concern because it looks like placements are expected to be about 7% above last year. On feed inventory is projected at 102.1, and the consensus is that marketings are going to be a little bit lower than last year at 98.1. Now the ranges are pretty wide, especially on the placement side, between about 102 to 108. This caught the market way off guard last time. The managed money was definitely leaning towards the longer side of the market and maybe a little too heavily based on the supply. So we've seen the price structure kind of tank yesterday. Again, that's probably more concern over these little bit more abundant supplies than the market had been anticipating. Beef prices are slipping. Cash prices so far have been on the kind of downswing here as well, slipping below 180, just kind of on the average steer prices. So everything's kind of leaning negative still. It's not without hope. There are definitely tools to manage this kind of thing. You've touched on the LRPs a couple of times, and it looks like, a 13-week endorsement on the fed cattle side or a 17-week with like 95, 96% coverage is right around that $2 per hundredweight. So I think that's a pretty good bang for the buck for anybody that really just needs to try to want some coverage. We're at historically high levels. Prices could go a lot lower, especially if we start seeing any kind of signs that consumer spending is lightening up, wage growth is starting to slow down. We're already seeing it on some regional areas. McDonald's is raising prices. So more strain to the consumer is not good for beef movement, and it's not good for cattle prices in the long run. So I think it's just a good environment to stay protected. Hog market staying up pretty well on seasonal, but last week we saw weights really jump hard from last year. So I don't want it to say things are getting backed up, but looks like we have a pretty decent supply, and the market's been kind of weakening up, more so just stabilizing than an outright collapse. But cash prices tend to erode here, so we just want to stay kind of covered this year with LRPs, put options. Cattle on feeder report could be a doozy, so just stay safe.
I appreciate that, Rye. We just opened the markets here this morning. I'll give you a quick rundown. December corn down 4 1/4 at 470 3/4. January beans down 11 1/2, 13.49, and December Chicago wheat's down 4 3/4 at 5.49. Any parting shots before we head into the weekend here, guys? All right, I think everybody's good. We appreciate everybody tuning in. Thank you for all your contributions and supporting the podcast here. And we hope everybody has a great weekend, and we look forward to talking to you next week.
Thanks,
Dan.
Thanks, Dan.